The Federal Reserve made a decision that will affect every wallet, currency, and financial market in the world. But the decision to raise interest rates isn't really all that clear cut. This is because of the financial crisis, which happened nearly a decade ago. It caused the worst U.S. recession since the Great Depression, and its effects are still being felt today. To deal with the crisis, the Fed slashed interest rates to depths never before seen. It also agreed to bail out some of the country's biggest banks, with Bank of America, Citigroup, JP Morgan Chase, and Wells Fargo receiving the most money. But even that wasn't enough. The Fed was also forced to take steps that some central banks would never even dream of, eventually buying $3.5 trillion in bonds. This flooded the financial markets with cash and was meant to restore consumer and investor confidence, encouraging investment, hiring, and economic growth. So, the worst of the crisis was in 2008. What's happened since then? Well, the Fed kept interest rates near zero for longer than anyone would have imagined, and it didn't nudge them up for 7 years. For the first time at the end of 2015, and again this December. And even then, each nudge was only 1/4 of 1 percentage point. But deep in the plumbing of Wall Street, where the Fed began paying a bit more to borrow short term from banks, the message was loud and clear. Fed Chair Janet Yellen and her colleagues figured the economy was getting healthier. Because the Fed is so influential, and because the dollar is the world's reserve currency, everyone would feel the effects. But even with U.S. unemployment at half of what it was during the crisis, and with stocks in their second longest bull market ever, the economy still hasn't broken out of the doldrums, and inflation remains stubbornly low. The Fed has been sitting on its hands for a year now, even after initially predicting that it would continue pushing rates higher throughout 2016. It was the surprises from abroad, like the market sell off on fears that China was slowing down, and Britain's unexpected Brexit referendum to leave the European Union, that were blamed for the hesitation. However, despite the mixed signals, Yellen has insisted that the delay does not reflect a lack of confidence in the economy. The 17 decision makers sitting around the Fed's mahogany table in Washington arrive with differing perspectives. One camp is very keen to keep raising rates for fear the Fed has waited too long and the economy will get too hot, sparking too much inflation and leading to another crash. They're called the hawks. On the other side of this argument are the doves, including usually Yellen. They are deeply concerned that many Americans don't work as much as they want or have given up looking for work altogether. They see no urgency in aggressively raising rates until they're forced to. Now that the Fed has raised rates twice, the big question is, how aggressively will these doves and hawks continue hiking through 2017, especially as Donald Trump takes office and rolls out policies that could sway the economy one way or the other?